Hey there. So, the IRS has new adjusted tax brackets for 2023, and there's good news and there's bad news. Good news, we're going to talk about. Bad news, we're going to talk about. We're going to get into it because it may save you hundreds or maybe thousands of dollars on your taxes. But first, I'm Micah. This is the Common Sense Show. So it's Micah, and I am back with another episode of the Common Sense Show. Today, we're talking about the new IRS tax brackets and standard deductions that could save you hundreds or maybe thousands of dollars. But there is a bit of bad news. I wanted to go over this article with you because it's very important for you to understand that these things are actually being updated because it affects everyone who pay taxes in America, which is pretty much everyone. So let's start at the beginning and end at the end. So we know that the IRS is trying to, or the federal government is trying to do things to stem inflation. And some of the things that they're doing right now to work on inflation is adjusting the 2023 income tax brackets up. So what this means is that what they've done is they have taken the income tax brackets and the widely standard deduction, and they have adjusted these to actually accommodate for inflation. According to this article by Market Watch, the payout on the standard deduction is jumping 7% from 2022 to 2023. The IRS numbers show that that is the gap that they're actually trying to cover. Currently, the standard deduction is $27,700 for a married couple filing jointly, an $1,800 increase from this year's payout. It will increase to $13,850 for individuals, and married couples filing jointly, separately, it will increase not by $900. And so, in addition to the standard deduction increasing, there has been an increase in actual new tax brackets. Yes, believe it or not, the new tax brackets for 2023 are being increased.
Alrighty then.
Yes, so things are going to change for the 2023 tax year. A married couple with taxable income of about $200,000 in 2022 and 2023 are going to see a reduction in their tax bill of nearly $900. A couple, for instance, making $500,000, according to this article, of income would see their tax bill fall by over $3,700. Now, unless you make the 500 grand, doesn't really matter to you. But what's happening is, based off of the inflation adjusting up, they've also adjusted the averages of the income for individuals as well. So now, basically, the breakdown on this is that the actual percentage of income is not changing. So like the 10, 15, 20, 25%, those are going to remain the same. But the amount of money that you actually pay in taxes is going to go down because your tax bracket is going to stay stationary, but the income required to hit those percentages that trigger you to contribute taxes is going to go up. So essentially, you need to make more money in order to trigger some more tax, to trigger the tax. So you're not going to get taxed at the same rate. So 10%, according to your income, is going to be different this year than it is next year. So I just gave you an example of how. So let's go over a few more examples here. It says for single taxpayers at those same income levels, their tax bills would be reduced by roughly $1,400 and $1,900 respectively, and that's on $200,000 and $500,000 in income. A married couple with no kids that made $150,000 this year and next year would pay $1,015 less on their 2023 federal income tax bill. And a single filer with no kids making 150 grand this year and next year would face a tax liability that was about $652 smaller. So there's that. A couple married without kids making 75 grand this year, next year would pay $245 less on their 2023 taxes. And a single filer would save just over $500. So these are just examples of what's going to happen to the tax bracket for individuals for next year. So the actual rates for income tax are remaining the same. So the rates for income tax are currently 10%, 12%, 22%, 24%, 32%, and 35%. And so those are the tax rates. And remember that in the US, we have a progressive tax rate. So the more money you make, the higher percentage of taxes you actually pay. But what's being adjusted now is they're adjusting that income even higher, so that 10% is less of the income, taking less percent of the income than it was before, to try to help fight inflation. And so the article goes on to say that it's a hypothetical that might not fit entirely with the tight labor market, but many employers are cutting fatter paychecks to hold on to staff. But the tax question is where increased wages land in relation to the upward adjusted tax bracket. So the idea here is not that people will pay less tax, said Howard Gleckman, a senior fellow at the Tax Policy Center. The idea is to keep your tax liability relatively stable and avoid what's called bracket creep, where inflation pushes someone into a bigger tax bill when they don't have the spending power to be able to afford it. That is a major problem right now, which is that people are getting pushed into a higher tax bracket because the wages are going up and inflation's going up. However, your tax bill also remains high too. So to offset that, they are increasing these numbers so that you're not seeing shocking amounts of increase in your tax bills. Not that everyone's income moves at a lightning clip on a regular basis. And there is a standard deduction that people can choose to take. We talked about that a little earlier. And so you can choose to take what's called a standard deduction and an itemized deduction. So a standard deduction basically takes your income and gives you one flat rate deduction that you can just take one time, right, during the tax year, as opposed to the itemized deduction, which allows you, if you file a 1040, or if you have a business, to itemize all the deductions of things that you paid off during the year. And the goal between the standard deduction and the itemized deduction from tax strategy. And before we go into this, just know I am not a CPA. I am not an accountant. This is just for educational purposes. You should all go see your CPA. Okay, now that we've gone through that. So basically, if you notice that your itemized deductions for a year may be less than the standard deduction, then you have the option of taking the standard deduction. If the itemized deductions are more than the standard deduction, then you could elect to take the standard deduction. And based off of what we're talking about here, the standard deduction was also increased to allow you to be able to take a little more deductions on your income for the year. So it makes sense to itemize when the sum of the potential write-offs is larger. We just talked about that than the potential standard deduction. And so most people, from what I understand, get the standard deduction, but some of us, like myself, who file additional business income and personal income, use itemized deduction because we end up spending more. So these aren't the only tax adjustments that were made for the upcoming year. The IRS also increased the thresholds for deductions to IRAs and 401k. So this year, individuals can put up to $20,500 in their 401k, an increase of from $19,500, so $1,000 difference. And then it's for IRAs, I believe it was still $6,000 this year as well. But the IRS says people can put up to up to $6,500 next year in IRAs, which are about a 10 and 8% increase for the limit set in 2022. So you have the opportunity to actually contribute more to your IRA and actually get a bigger tax deduction this year. I understand the concern about IRAs and tax deductions this year, which are that the market is not great. So these deductions are great. However, at the moment, the market is not great not ripe for trying to track the S&P and the Dow. However, you get more money, you get more stock for more bang for your buck now. When the market's lower, you can buy more stock if you have the available capital to do that. Then when it's higher, you get less. So from a dollar cost averaging standpoint, if you're putting in money constantly, whether the economic times are good or bad, you're going to be able to buy more and buy less just generally over time. So it's so important for you to continue, if you can, maintaining, contributing to that 401k, building up that retirement savings and the IRA. So there's a couple of problems though that we have to deal.
We have a problem. We have a problem. Ladies and gentlemen, we have problems.
Thank you, Stephen A., for putting it so eloquently. The issue is that all these new tax bumps and tax savings are all well and good. However, if you're struggling right now, you can't even put your increased tax refund into your gas tank until 2024. So remember, these are the 2023 adjustments that are being made to the tax bracket, to the deductions for the IRA and the 401k. These provisions are not necessarily going into effect right now, especially specifically the tax bracket change with those deductions. Those don't go into place until 2023. And so you won't even realize that change until at least February of 2024. So it's great that this is being done. However, the issue is that you have to basically wait over a year to even get something from it. So good news in the long run and on the horizon, but as it stands right now, there's not much you can do about it. You just have to wait. But hopefully you can get enough deductions from this past year where you can kind of make it work. So that's really the latest. So again, just to recap, the tax brackets are changing. The income levels for each segment of where taxes occur. So taxes occur at 10, 12, 22, 24, 32, and 35%. IRS, federal government, is raising the incomes for each one of those tiers. And so the gross amount of your taxes will be lower given that they've increased the income thresholds for those specific brackets. So that is the latest update from the IRS. But remember, you can't take advantage of it until, frankly, next year. All right. Well, thank you for tuning in today. I thought I would give you a quick 15-minute-ish overview of what's going on with tax brackets and how that's changing, how that might affect your income, your personal wealth. So just remember to plan wisely. This crucial now that you find different ways. If you're still making the same money and you're not actually that affected by your income, or your industry is not affected necessarily or hasn't been by the recession or the increase in inflation, well, we're all affected by inflation. But if you haven't been that impacted, look for things to invest in right now. This is when you do it, when things are cheaper, when things are on sale, when things change. You don't want to wait until things get expensive again. Put away some money to start investing. Do not wait for things to get more expensive. It's just going to cost you more in the long run. So, thank you for tuning in today. I'm glad I could go over this information. Don't forget to subscribe to the Common Sense Show on Locals. Also, if you're watching on YouTube, don't forget to hit the like bell, hit the subscribe button and the like bell so you get notified when videos come out. If you're listening to this on podcast, don't forget to hit the subscribe button so you can get podcasts to your device wherever you get your podcasts. Thank you for tuning in. This is Micah. I'll talk to you later.